There's a hidden trap in home equity that's costing homeowners thousands right now, and most people don't realize they've fallen into it until it's too late. Hi, I'm Jonathan Wells, mortgage lender and branch manager with a decade of experience in the lending space. I've helped thousands of people just like you achieve their goals while being budget and wealth conscious. So if that sounds good to you, let's get into the video. Now, before we dive deep, I want you to ask yourself something. Have you ever needed cash for something important and thought, my house has all this equity just sitting there? Maybe it was for a home renovation, or maybe it was to pay off high interest debt, or maybe you just wanted to invest in something that could actually grow your wealth. Well, here's the problem. Most people think that there's only one way to access their equity. They walk into the bank and someone tells them, let's do a cash-out refinance. And then they go sign papers, and without realizing it, they've just made a very expensive mistake. Because here's what nobody tells you. There are actually two main ways to pull equity from your home: a cash-out refinance and a HELOC. And choosing the wrong one could cost you tens of thousands of dollars or lock you into a loan that doesn't fit your life. So in this video, I'm going to break down the key differences between a HELOC and a cash-out refi. I'm going to show you exactly which one makes sense for your situation. And I'm going to tell you the one mistake that almost everybody makes when they're trying to access their equity. And listen, if you're serious about making the smartest move with your home equity, I've got a free questionnaire that'll show you just how home ready you are and what options make the most sense for your financial situation. I'll drop the link in the description below. All right, let's start with the basics. A cash-out refinance means that you're replacing your current mortgage with a brand new one, and that new mortgage is bigger than what you currently owe. So let's say, for example, you owe $200,000 on your home, but your home is worth about $400,000. Well, you could refinance into a new $300,000 loan, pay off the original $200,000, and pocket the extra $100,000 in cash. Now that's a cash-out refinance. Now a HELOC, which stands for Home Equity Line of Credit, is totally different in that it's like a credit card tied to your house. You're not replacing your mortgage, you're just adding a second loan on top of it. And here's the kicker. You don't have to take out all that money at once. Let's say that you're approved for a $100,000 HELOC. You could take $10,000 now, $20,000 next year, and leave the rest untouched. And you only pay interest on what you actually use. So right away, you can see that these are really two different animals. And that's where people get stuck, because on the surface, they both give you cash, but the way they work, the cost, and the flexibility are all totally different. And here's the thing, your loan officer might only offer you one of these options, not because it's the best for you, but because it's the easiest for them to process, or because they make more money on one versus the other. And I've seen it happen over and over again. So let me tell you a quick story. I had a client a few months ago, let's call her Sarah. Sarah had a mortgage at 3% interest when she bought her house a few years ago, and that was when rates were significantly lower. She owed about $300,000 and her home was worth about $500,000. She needed $50,000 to redo her kitchen and add a bathroom. So she called her bank and they said, no problem, we'll do a cash-out refinance. Sounds great, right? Wrong. Because here's what they didn't tell her. When you do a cash-out refi, you're wiping out your old loan and starting over. And that means that Sarah's 3% interest rate is gone. Her new loan is at 7%, so now she's paying 4% more on the full $350,000 loan just to get $50,000 in cash. So let me say that again. She went from a 3% mortgage rate on a $300,000 loan to 7% on a $350,000 loan. Her monthly payment jumped by over $1,000, all because she needed $50,000. And that's the hidden trap. Now, if Sarah had came to me first, here's what I would have told her. I would have said, Sarah, you don't need a cash-out refi. You need a HELOC. Because with a HELOC, we could have gotten her that $50,000 without touching her 3% mortgage rate that she currently had. So she would have kept her low payment on the original loan and only paid interest on the $50,000 at the HELOC rate, which, yes, might be higher, but it's only on $50,000, not the whole loan. Do you see the difference? That one decision would have saved her hundreds of dollars every single month, and over the life of that loan, we're talking tens of thousands of dollars. So here's the first big takeaway. If you have a low interest rate in your current mortgage, a cash out refi could be the wrong move because you're not going to trade in that low interest rate for a higher one, and that's really expensive. like really expensive. Now you might be thinking, okay, John, so a HELOC is always better then, right? Well, not so fast, because there is a flip side to this, and this is where things get interesting. So let me tell you about another client. His name was Mark. Now Mark also needed cash, about $100,000 worth, because he wanted to buy an investment property. But here's the difference. Mark's mortgage rate was 6.5%. Now this is because he bought his house more recently, so his rate was already high. When we ran the numbers, we realized something. If we did a cash-out refi, he could actually lower his rate to about 6% and still give him $100,000 that he needed. So in Mark's case, cash-out refinance actually made total sense, because he wasn't giving up a good rate. He was actually improving it. And on top of that, he got a fixed rate 30 years, which gave him way more stability and predictability. A HELOC, on the other hand, would have been at a variable rate, meaning it could go up or down with the market. And for someone like Mark, who wanted to know exactly what his payment would be every month for the next 30 years, the cash-out refi was actually the smarter play. So here's the second big takeaway. If your current mortgage rate is high, or if you want a large amount of money with a fixed payment, a cash-out refinance might actually be the better option. Are you starting to see how this works? It's not really about one being better than the other. It's all about your situation, your rate, your goals, how much cash you need, and how long you plan to keep the loan. And that's exactly why most people get this wrong, because they're not asking the right questions. All right, now let's talk about the details, because the devil's always in the details, right? Let's start with closing costs. When you do a cash out refi, you're going to pay closing costs just like when you bought the home. We're talking about appraisal fees, title fees, origination fees, all that stuff. On a $300,000 loan, you might pay anywhere from $5,000 to $10,000 in closing costs. Now, some of these lenders will let you roll these costs into the loan, but that just means you're financing them. You're still paying for them, you're just paying them over 30 years with interest. A HELOC, on the other hand, actually has way lower closing costs. So if you're trying to keep your upfront costs low, a HELOC wins here. But there is something that most people don't know about. A HELOC is almost always on a variable rate. That means that your interest rate can change. If rates go up, your payment will go up. And if rates go down, your payment will go down. Now, some people like that flexibility, especially if they think rates are going to drop in the short term. But other people hate it. They want to know exactly what their payment is every month. And a cash out refi gives you that. It's a fixed rate for the life of the loan, usually 30 years, and your payment stays the same no matter what happens in the market. So another question to ask yourself is, do you want predictability or flexibility? And that's honestly a big part of this decision. Now let's talk about the draw period and repayment. This is super important with a HELOC. Most HELOCs have what's called a draw period, usually 10 years, and during that time you can borrow money, pay it back, and borrow money again. It's revolving just like a credit card. And during that draw period, you usually only have to pay the interest, not the principal balance. So your payments can be pretty low. But here's the catch. After the draw period ends, you enter the repayment period. And now you have to start paying back the principal plus interest. And that means your payment can jump a lot. I've seen people get shocked when their HELOC payment doubles after year 10 because they didn't plan for it. So if you're getting a HELOC, you need to have a plan. Are you going to pay it off during the draw period? Are you going to refinance it later? Or are you prepared for the payment increase? You've got to think ahead. With a cash out refi, there's no draw period. You get the cash up front and you start making payments immediately. Principal and interest every month for 30 years. It's that simple. It's predictable, but it's also less flexible. So here's another question you need to ask yourself. Do you need all the money right now, or do you need access to the money over time? If you're doing a one-time project like a kitchen remodel, and you know exactly how much it's gonna cost, a cash out refi might make sense. But if you're doing a project in phases, or if you're just not sure exactly how much you'll need, a HELOC gives you way more flexibility. You can take what you need when you need it, and you're not paying interest on money you're not using. That's powerful. All right, now let's talk credit score and approval. Both a HELOC and a cash out refi are going to check your credit, but generally a cash out refi has stricter requirements, and lenders want to see a higher credit score and a lower debt to income ratio. They also want to see more equity in your home. With a cash out refi, most lenders want you to keep at least 20% equity in your home after you cash out. So if your house is worth $400,000, you can usually borrow up to $320,000, which leaves you with about $80,000 in equity, or 20%. Now with a home equity line of credit, it's a little bit more flexible. Some lenders will let you borrow up to 90% of your home's value. so that you can tap into more equity. But that also means you're taking on more risk. If the housing market drops, you could end up owing more than what your home is actually worth. And that's not a position that you want to be in. So here's the next big takeaway. If you need access to a lot of equity and you don't have perfect credit, a HELOC might be easier to qualify for. But if you want the stability of a fixed rate and you meet the requirements, a cash-out refi could be the better long-term play. Now, I want to address something that almost nobody talks about, and that's taxes. When you take cash out of your home, whether it's through a HELOC or a cash-out refi, that money is not taxable income. You're borrowing against your home and you're not selling it. So you don't owe any taxes on the cash that you receive. But here's where it gets interesting. The interest you pay on the loan might be tax deductible if you use the money to buy, build, or substantially improve your home. The interest is usually deductible. But if you use the money on something else like paying off credit cards or buying a car, it's not deductible. So if you're planning to use the cash for home improvements, make sure you keep good records. That interest deduction can save you thousands of dollars at tax time, and this applies to both a HELOC and a cash-out refi. All right, now let's get into the strategy, because this is where the pros separate from the amateurs. Here's a scenario I see all the time. Someone has high interest debt, credit cards at 20%, car loans at 8%, personal loans at 12%, drowning in payments, and they've got a ton of equity in their home. So they think that they'll do a cash out refi, pay off all this debt, and consolidate everything into one low payment. And on paper, that sounds great, but here's the problem. You're taking unsecured debt and turning it into secured debt. What does that mean? Well, it means your credit card debt isn't tied to anything. So if you stop paying it, your credit score tanks, but you don't lose your house. So when you do a cash out refi to pay off all that debt, well, now that debt's tied to your home. And if you can't make the payment, you could lose your house. So you've got to ask yourself, why did I get into debt in the first place? If it was a one-time emergency and you've got your spending under control, then consolidating with a cash-out refi or a HELOC might make sense. But if you got a spending problem and you're going to rack up those cards again, then you're just digging yourself a deeper hole. And now your home is on the line. I've seen people do this. Pay off their credit cards with home equity, and then max out their cards again. And now they've got a new mortgage payment plus all the credit card debt. Don't be that person. Now, here's a smarter strategy. Let's say you've got a credit card debt, but you've also got a great rate on your mortgage. You can use a cash flow analysis calculator to see how consolidating your debt can free up hundreds or thousands a month. And then if you compare that to a HELOC that has a variable rate, you could be in a safer position by doing a cash out refi. Then you aggressively pay down your new mortgage and you throw every extra dollar at it. And as you're paying it off, you still have that cash flow available if you need it in the future. That's a smart, flexible strategy, and it keeps your options open. Here's another scenario. If you want to buy an investment property and you've got equity in your primary home, should you do a cash out refi or a HELOC? Well, the answer depends on if you're using the cash as a down payment on the rental property. A HELOC might make more sense because you're only borrowing what you need for the down payment, and the rental income from the new property can help you pay off the HELOC. But if you're buying the property outright with cash, a cash out refinance might give you a better rate and a fixed payment, which will make your budgeting way easier. You see how this works? It's all about strategy. It's about looking at your whole financial picture and asking, what's the smartest move? Not just what's the easiest. All right, now let's talk about timing, because timing matters a lot. And if you're thinking about accessing your home equity, you need to think about where interest rates are headed. Right now, rates are higher than they were a few years ago. If you got a mortgage at 3 or 4%, doing a cash out refi right now is probably going to cost you. You're going to trade in that low rate for a higher one. So unless you absolutely need the money, or unless you're in a situation like Mark where you can actually lower your rate, I'd probably tell you to wait or go with a HELOC. But here's the thing about HELOCs, they are variable. So if rates drop, great, your payment drops. But if rates go up, your payment goes up. So you've got to be comfortable with that uncertainty. Now, if you think rates are going to come down in the next year or two, a HELOC might be the perfect short-term solution. You can access the cash now, and if rates drop, you can refinance the HELOC into a fixed rate loan later. Or you can pay it off. That's the flexibility I'm talking about. But if you think rates are going to stay high or go higher, and you need the money right now, locking in a fixed rate with a cash out refi might give you more peace of mind. even if the rate's not perfect. So here's the next big takeaway. Think about where rates are right now and where they might be going. That should also play a big role in your decision. Alright, so I give you a lot of information. Now it's time for a simple framework. I want to give you a way you can think about this so you can make the right call for your situation. Ask yourself these 5 questions. Number 1, what is my current mortgage rate? If it's low, protect it. Don't do a cash-out refi unless you absolutely have to. If it's high, a cash-out refi might actually help you. Question number 2, how much money do you actually need? If you need a large sum all at once, cash-out refi might make sense. But if you need access to money over time, or you're not sure exactly how much you'll need, go with a HELOC. Number 3, do I want a fixed payment or flexible access? If you want predictability, go with a cash-out refi. And if you want flexibility, go with a HELOC. Number 4, what am I using the money for? If it's for home improvements, both options work, and the interest might be tax deductible. If it's for something else, just make sure you're being smart about it. And number 5, what's my plan to pay it back? This is the most important question. Don't just think about getting the money. Think about how you're going to pay it back. Do you have a plan? Can you afford the payment? Are you prepared for a payment increase if you get a HELOC? You've got to think long term. All right, so let's do a quick recap. Cash-out refinance replaces your current mortgage with a new, bigger one, and you get the cash. But you also get a new interest rate and a new 30-year term. It's best if your current rate is high, if you need a large lump sum, and you want a fixed payment. A HELOC is a line of credit that sits on top of your mortgage. You can borrow what you need when you need it, and you only pay interest on what you actually use. It's best if you have a low rate that you want to protect, or you need flexible access to cash, and you're comfortable with a variable rate. And here's the biggest mistake that most people make. They don't compare both options. They just go with whatever their bank offers. Or they make a decision based on what sounds easiest instead of what's actually best for their financial situation. Don't do that. Take time to run the numbers and talk to somebody who knows what they're doing. Look at both options because the right choice could save you thousands of dollars or tens of thousands, and the wrong choice could cost you your financial flexibility or even your home. Now listen, I know this stuff can feel overwhelming, but there's a lot of moving parts, a lot of numbers, and a lot of what ifs. That's exactly why I offer free mortgage consultations where you can get 15 minutes of my time to review your scenario and get expert advice. I'll drop the link in the description. It takes 15 minutes and it'll give you a clearer picture of where you stand. And if you're finding this video helpful and you want more content like this, hit that subscribe button. I drop new videos every week breaking down real mortgage strategies that actually help you build wealth, not just get a loan. All right, now I want to answer a question from the comments, and this one's from Jennifer. She says, John, I have a HELOC that I opened 5 years ago. The draw period is almost over, and I'm nervous about the payment going up. What should I do? Great question, Jennifer. Here's what I'd recommend. First, look at how much you owe on the HELOC. If it's a small amount, try to pay it off before the repayment period starts. Even if you have to tighten up your budget for a few months, it's worth it to avoid that payment jump. If you owe a larger amount and you can't pay it off, consider refinancing the HELOC into a fixed rate loan. You could do a cash-out refi in your primary mortgage and roll the equity loan into it. Or you could look into a personal loan or a fixed rate home equity loan, pay off that existing HELOC. The key here is don't just let the repayment period hit you by surprise. Be proactive. Run the numbers now, talk to a lender, make a plan. Because the worst thing you can do is nothing at all. All right, here's the bottom line. A HELOC and a cash-out refi are both tools. And like any tools, they're only as good as the person using them. If you understand how they work, when to use them, and what your goals are, you can make a smart decision that sets you up for success. But if you just go with the flow and do what somebody else tells you without asking any questions, you could end up in a really bad situation. So be smart, ask questions, run the numbers, and make the decision that's right for you. Not for the bank, not for your loan officer, for you. And listen, if you like this video, you'll love the next one. I'll see you there.